Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest high-energy updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at 9 a.m., noon, and 7 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Well, ladies and gentlemen, something just happened with XRP, right after a major move tied to Trump. And at first glance, it looks bullish. Markets are reacting. Crypto is moving. Confidence is coming back. But when you look closer, something doesn't add up, because this move might not actually be about price at all. It could be pointing to something bigger, something that's been building quietly for years, and most investors haven't connected it first. Let's zoom out for a second. Before we even talk about XRP, we need to understand what the market is reacting to right now. Over the past few weeks, markets have been dealing with uncertainty, geopolitical tension, unexpected global events, and one of the biggest potential escalations involving Iran. Now, here's the key: markets don't just react to bad news. They react to uncertainty. Let that sink in. And that's what we started to see is a shift. Signals from both sides pointing towards de-escalation, a path toward resolution. And almost immediately, markets moved. Stocks pushed higher. Crypto followed. But here's where it gets interesting. The speed of this reaction tells you something. This wasn't just relief. It was positioning. And when you bring that back to XRP, the move starts to look different. Not just a reaction, but potentially a signal. Let this sink in. And that's where we need to dig deeper. Ladies and gentlemen, I just want to thank everybody that takes the time to like, subscribe, share, and comment on our videos. These simple things really do help with the channel a lot. And if you're new here, I want to tell you that these videos are broken into two pieces. The second part is a rant everyone's come to love. With that being said, I hope you enjoy the content, and let's dissect this. Let's start at the top, because even when we talk about XRP, we need to understand the environment it's reacting to. Over the past few weeks, markets have been navigating uncertainty, geopolitical tension, unexpected global events, and one of the biggest potential conflicts escalations involving Iran. Now, here's the thing. Markets hate uncertainty more than anything else. Not bad news, not even crisis, uncertainty. And what we started to see recently is a shift. Signals from both sides suggesting de-escalation, a path toward resolution. And almost immediately, markets reacted. Stocks moved. Crypto moved. Risk appetite started coming back. Now, this part surprised a lot of people because it happened fast. But historically, this is exactly how markets behave. I want you to think back to a previous global event, okay? Oil crises, wars, financial shocks. There's always a moment where the narrative shifts from things are getting worse to maybe we're coming out of this. And at that moment is where capital moves first. Not when everything is fixed, but when the direction changes. And that's what we've been seeing right now. So let's zoom in and look at the XRP reaction. Now, this brings me back to XRP, the anointed one, because XRP didn't just move, it reacted. And on the surface, that makes sense. Less global tension leads to more confidence. More confidence leads to more capital flow. More capital flow leads to more asset prices rising. It's simple. But here's where it gets interesting. The way XRP is reacting doesn't fully line up with just a macro bounce. And this is what most investors are missing. So something feels off, ladies and gentlemen. Because when you look at deeper price, this isn't just about a price reaction. It's a signal. And we've seen this before. Moments where the market moves, but the real story isn't the move itself. It's what's happening underneath. Let's talk about Ripple's long game. Now, we need to talk about Ripple, because this is where things start connecting. For years, Ripple has been doing something very different from the rest of crypto. While most products were focused on hype, price, retail attention, Ripple focused on something else entirely. Relationships, working with banks, testing with institutions, building connections with regulators. For a long time, people criticized this. They said, those partnerships don't matter. They suck. They're not real adoption. They suck. Nothing is happening. They suck. But here's the reality. Those early relationships are now starting to materialize. So proof points Take Western Union as an example. For years, just speculation, old documents, rumors. Now, partnerships. And that's not an isolated case. We're talking about connections to major global banks, interaction with central banks, exposure to payment infrastructure worldwide. Some estimates suggest Ripple has touched 25% of central banks directly, 37% through indirect relationships. Now think about that for a second. Because this is where it gets interesting and spicy. If even a fraction of that infrastructure, a fraction, moves towards blockchain rails, what does that mean for networks like XRP? Let's talk about regulation and timing. Here's the piece. Institutions don't move on hype. They move on regulation, compliance, risk management, and for years, that's been the bottleneck. Not technology, not demand, clarity. Let this sink in, ladies and gentlemen, let this sink in. And now we may be entering a phase where clarity is starting to form. So let's talk about temporary versus structural, very important. This is critical to understand, so stay with me here. Short-term noise, long-term structure. Write that down. Short-term noise, long-term structure. I always tell you to pay attention to what's quiet, ladies and gentlemen. I always do. Price reacting now, that's noise. Infrastructure being built, that's the structure. And what we may be seeing is the early stages of structure starting to surface. Let's talk about the quantum threat. This is a big threat and big shift. Now let's shift gears, because this is where things take a serious turn. A report coming out of Google suggests that quantum computing may be arriving faster than expected. Go figure, right? And this isn't just tech news. This has massive implications for crypto. So the problem, because here's the issue. Most blockchains today, Bitcoin, Ethereum, Solana, they rely on cryptography systems that may not hold up in quantum world. And here's the dangerous part. Many wallets on those networks cannot be upgraded. Let this sink in. That's so massive. So this means if quantum computing reaches a certain level, those wallets could be exposed permanently. So the scale of risk, we're talking about millions of wallets. Write that down. Potentially a huge percentage of supply. Even dormant wallets. Even early wallets. Even Satoshi era holdings. Now imagine what happens if those assets get accessed, moved, sold. And this is what most investors are missing. This isn't just a tech problem. It's a market structure problem. Now here's where XRP enters the conversation. XRP difference. XRP. Because XRP Ledger was built differently. It supports key rotation, meaning wallets can be upgraded. Security can evolve. The system can adapt. The institutional shift. And this leads to another major shift, custody. Because as systems get more complex, security becomes more critical. And retail may not be equipped for what that means. And what this means, institutional custody solutions could become dominant. So let's go full circle. Stay with me. Now, bringing this all together, macro stabilizing, institutions preparing, technology evolving, security becoming critical, and XRP sitting right in the middle of it all. So the real takeaway, ladies and gentlemen, so when you look at XRP moving after Trump-related macro shift and something feels off, you're not wrong, because this might not just be a reaction. It might be a signal. My final thought, we may be entering a phase where price is reacting, but the system is evolving. And historically, that's where the biggest opportunities form. Not when everything is obvious, but when things don't quite make sense. Ladies and gentlemen, you made it this far. You're already ahead of most of the market. Drop a comment below. Give me a like. Subscribe. Do you think this move is macro-driven or something different or deeper? And if you're part of the wolf pack, you already know. We're not just watching price. We're watching structure. Hit like, subscribe, and I'll see you in the next one. Well, ladies and gentlemen, what a time to be alive. Very interesting things and developments we're seeing. I want to welcome all the new members of the Patreon, all the members of the membership channel. If you see how the news is being moved and used right now to control prices, it's unbelievable. It's really, I was just on the phone to a massive family office in Singapore, and I'm describing this. No, this is like the reincarnation of Harry Houdini could make an elephant disappear in front of an audience, a distraction. And if you made it to this part, ladies and gentlemen, here's the ice of the candy of the Italian ice. So, ladies and gentlemen, just remember, One good tip from the pits can easily pay for your entire year's subscription. If you want the deeper macro research and learn how to take advantage of everything that we rant to talk about, do come and join over 470 active traders and investors in the Patreon, the Crypto Republic Desk Monthly. And welcome all the new members. It doesn't matter if you're just starting to become a financial mercenary or you're seasoned, we break it all down. Ladies and gentlemen, Iran has just turned the Strait of Hormuz into a toll road and a Petro One field test. It's crazy. This is nuts. So Iran has formalized control over the Strait of Hormuz via a legal management plan. Go figure, management plan, turning a military choke point into a regulated toll-based transit system with selective asset. The framework challenges international law, but creates enforceable facts on the water, with no near-term mechanism for legal reversal during active conflict. So ships must undergo IRGC vetting and pay transit fees reportedly around 2 million in yuan, with allies often exempt and adversaries denied. System acts as a proof of concept for non-dollar energy settlement, embedding yuan-based transactions to a critical global choke point, oil. Iran's Paramilitary National Security and Foreign Policy Committee has approved an 8-point Strait of Hormuz management plan. Go figure, right? Formalizing in law what has already been enforced operationally since March. Again, the framework imposes a real boost toll on vessels, bans U.S., Israeli, and sanctioned aligned ships, and asserts Iranian sovereign control over the transit. Think about that, right? While coordinating legalities. It's unbelievable. I mean, I can't even believe that we're actually talking about this, but this is unbelievable as far as I'm concerned. So they're trying to coordinate it with Oman, though still requiring a full legislative approval. The move effectively transforms a military choke point into a regulated maritime regime. Wow. The plan challenges established international law under UNCLOS, which prohibits tolls or obstructions in key transit traits and situations. Iran's counterargument rests on territorial sovereignty and wartime conditions, asserting the right to regulate passage within its waters. With no immediate legal enforcement mechanism during active conflict, Iran is creating a de facto system that can only be contested after the fact. So if you look at this, ladies and gentlemen, operationally, vessels must undergo IRGC vetting, submit full documentation, and receive clearance for a tightly controlled corridor between Qashim and Lahat Islands. Escorts, verifications, procedures, and post-transit payments, reportedly around 2 million in yuan, are required. It's massive. Traffic has dropped sharply from pre-war levels, but select countries have negotiated exemptions to reduce fees, while others have been denied access. This system functions less as a blockade and more as a conditional border crossing. This is so massive of markets. I mean, we're trying to quantify all this. It's reducing the likelihood of direct military confrontation while embedding a new economic mechanism. Payments routed through non-dollar channels, including Chinese banking systems, position the corridor as a live test case for alternative energy settlement and infrastructure, particularly yuan-based transactions. Ladies and gentlemen, do you understand what that is, what I just went over? Do you understand how many opportunities this is going to lead to take advantage of alpha farming? I mean, I can't even believe what we're discussing, and I'm having to talk about this, but hey, if you look at this, and this is the big thing to pay attention, this is the financial mercenary take on this. Again, the winds of chaos are not kind. They affect everything. Unfortunately, people lose their lives. The one and only thing that you can do during financial chaos times is try to make your bank account bigger. They're taking advantage of the situations and bottlenecks that the disruptions cause, unfortunately. And as financial mercenaries, we take advantage of everyone. We don't get cut up like sushi because we are the remora swimming underneath the apex predators. We get the Gucci clarity, the Gucci mindset. Again, as we walk up this frosty mountain with our frosty beverage, the sight from the summit and the mountaintop is unbelievable. But this is what you got to be paying attention to right now. The dollar system is not breaking, ladies and gentlemen. It's rewiring. So from my perspective, not financial advice, what's happening right now is not being properly framed. It's not. This is not the beginning of a shift. It's the acceleration of one that has been building for years. I'm going to take the PhD out of PhD, stay with me, and how this leads into XRP, ICP, HBAR. A good example is how central banks are positioning. In many cases, they are reducing exposure to U.S. treasuries while not proportionally increasing gold holdings. Structurally, that's an imbalance, and it suggests that capital is moving without constraints, not purely with optimization. Now, at the core of this discussion is the petrodollar system. This system has historically anchored global dollar dominance by ensuring that energy, particularly oil, is priced and settled in U.S. dollars. That structure is now under pressure. We are seeing three simultaneous developments: growing share of oil being transacted outside of the dollar, energy flows increasingly shifting towards Asia, the build out of alternative settlement infrastructure. But it's critical to understand none of this is new, ladies and gentlemen. These trends have been developing for over a decade. What's changed is the speed and visibility. Write that down. The shift in Middle Eastern energy flows towards Asia is not geopolitical speculation. It is demand-driven. Asia is the marginal buyer. Capital flows demand. And at the same time, the infrastructure layer is evolving. We are now seeing the early formation of parallel systems, including, again, remember, I've been harping on this for a long time, BRICS-aligned payment frameworks, often referred to as BRICS Pay. Write that down. M-Bridge type initiatives, cross-border CBDC settlement rails. Write this down. Emerging unit-based or commodity-linked settlement concepts, the unit and similar models. Write this down. I've been harping about this. The units on ADA, Cardano, these systems are not yet dominant, but they are no longer theoretical, ladies and gentlemen. Again, they represent an alternative architecture to the dollar-based system. So to understand the full picture, I break the global dollar system into two primary pillars. One, petrodollar system, energy markets. Two, euro-dollar system, offshore dollar liquidity. Both are weakening for different reasons. The euro-dollar system structurally pressure. The euro-dollar system has been eroding due to several overlapping factors. The transition from LIBOR to SOFR, which fundamentally altered offshore dollar pricing, increasing geopolitical tension between the U.S. and Europe. The growing use of financial infrastructure as a geopolitical tool. Examples, conditional access to the dollar system. The rise of stablecoins and blockchain-based liquidity rails as potential substitutes. This system is no longer a frictionless or politically neutral as it once was. Write that down. Petrodollar system gradual erosion. At the same time, the petrodollar system is weakening as the world shifts towards a multipolar structure. Energy trade is no longer exclusively tied to dollar settlement. That brings us to the current geopolitical environment. If conflict, particularly in key energy regions, exposed to perceived limits on U.S. security commitments, it accelerates the incentive for countries to diversify away from the dollar. This is not about whether the U.S. is capable. It's about what it's willing to do. Write that down. Markets respond to perception as much as reality, and the response is already visible. Increasing oil settlement in non-dollar currencies, including yuan, strategic diversification of reserve and trade mechanism, reduced reliance on U.S.-controlled financial infrastructure. This is not a sudden reset. It's a slow structural transition, and that is becoming increasingly difficult to ignore. Ladies and gentlemen, what institutions are actually saying and what that means. Institutional reports often frame this as a risk. In practice, the language is conservative. What is actually being communicated is this. The current geopolitical and economic environment is accelerating the erosion of dollar dominance. This is occurring through currency diversification, energy trade realignment, alternative settlement systems, development. Data confirms the shift, ladies and gentlemen. The data supports this transition. The dollar's share of global trade is gradually declining. China is now purchasing significant more oil from Saudi Arabia than the U.S. The U.S. has moved towards energy independence. The last point is so critical, and the U.S. becomes less dependent on foreign energy. It's a strategic incentive change. Less dependence equals less necessity to maintain the same level of global enforcement of the system. This naturally leads to a more regional focused posture. So the big picture, stay with me. What we're witnessing is not collapse. It's a reconfiguration, a transition from a unipolar dollar-dominated system toward a more fragmented, multipolar structure with competing settlement mechanisms. The process is already underway. The only real question is this: do you position for this shift or assume the existing system continues unchanged? Ladies and gentlemen, the system is shifting. Most are missing this. Most people think what's happening right now is new. It's not. It's just becoming impossible to ignore. We're watching the slow rewiring of the global financial system in real time. And if you're okay looking at headlines, that's okay, but you're missing it. Here's what actually matters and what this means. The petrodollar isn't breaking. It's being replaced piece by piece. Oil is increasingly being traded outside the U.S. dollar. The Middle East is shifting flows towards Asia, where demand is growing. New systems are being quietly built. The BRIC-style payments rails, M-Bridge, CBDC cross-border settlement system, early-stage commodity-linked settlement concepts, the unit. This didn't start this year. This started over a decade ago. but now it's accelerating. Ladies and gentlemen, remember, again, the dollar has two pillars and both are under pressure. Petrodollar energy markets, Eurodollar global liquidity system. Both are weakening for different reasons. So if Europe is drifting from U.S. system, payment rails are being used as leverage. Stable coins are quietly building alternative liquidity layers. And at the same time, countries are actively reducing dependence on the dollar. Not all at once, but steadily. The trigger most people are missing and they're not thinking about, unfortunately. Geopolitics. If conflicts expose even the perception that the U.S. won't fully support certain regions, that's enough. Markets don't wait for confirmation. They move on perception. And what happens? More oil gets traded in other currencies. More countries hedge away from dollar exposure. The system slowly shifts underneath everyone. Ladies and gentlemen, the data confirms it. Dollar dominance in trade is declining. China, again, now buys far more oil from Saudi Arabia than the U.S. The U.S. is becoming energy independent. Think about the last one we just said. If the U.S. needs the Middle East less, it cares less, and that changes everything. Here's the reality. This is not a collapse. This is a transition, a move from one dominant system to multiple competing systems. Slow, structurally inevitable. So, ladies and gentlemen, what this means for you, me, everyone that retains any capacity, and everyone who's out there trading, most people wake up after this is totally obvious. By then, the positioning's already done. Inside here, ladies and gentlemen, we're not reacting. We're tracking it. We're breaking it down simply, and we're positioning ahead of the narrative. If this kind of breakdown helps you see the market clearer, the deeper the tips from the pits drops go even further, where capital is actually moving and how to position ahead of these shifts. What matters? And ladies and gentlemen, because one good tips from the pits can easily pay for your entire year subscription. If you want the deeper macro research and learn how to take advantage of this, come and join over 470 active traders and investors in the Patreon, the Crypto Republic Desk Monthly. And welcome everyone who's new, because this is happening right now, and it's really boring to most people. I went on rants and raves in previous videos about the unit, the bricks, challenging on the east side of the tranche. Remember our map? And the west side, the treasury system, leverage, debt. It's happening right now. People can be ostriches if they want, put their head in the sand. So the fact that this is happening is a big thing that people won't wake up until it's obviously too late to take advantage of this. But again, I want to talk about what's happening right in markets right now. Because if you're just looking at headlines, you're missing the real story. As of March 31st, 2026, we're no longer in a clean growth versus inflation environment. We're in something far more dangerous, far more profitable if you understand it correctly. We're in the early to mid stages of a stagflatory regime shift, and the market is starting to crack in very specific ways that most people are completely ignoring. And if you look at this, the signals are there, and a big thing about it is the 10 trillion debt that's got to be refinanced. And if you look at that, that's massive. And again, they're not paying attention to that. Positioning and momentum is at a whole all-time highs, and that's important. So what does that mean? It means that there's a lot of crowded trades that are beginning to break. And when the crowded trades unwind, they don't gently drift lower, they cascade. So if you zoom into semiconductors, specifically memory names, the basket dropped 5.69% in a single day. Another statistical significant move. Individual names down 7, 8, 9%. This is not technical selling. That's the market starting to question demand durability. Because if you're entering a stagflatory regime where growth slows but inflation stays sticky, what happens? Demand weakens, margins compress, and high multiple growth names get repriced aggressively. Now contrast that with what did work. Financials were up 1.1%. Energy is being aggressively bid globally. In Europe, integrated oil names are up 2.7%. Gas exposure up 3.6%. Even renewables catching a bid. This is not random sector rotation. This is capital moving toward real assets and cash flow durability. And here's where it gets even more interesting. At the same time, the energy is ripping higher. Gold ETFs just saw $12.2 billion in outflows in March, the largest monthly outflow in 5 years. Now, if you don't understand flows, you might think, okay, gold is dead, but look at the moves it just did. But that's exactly wrong conclusion, because ETF flows are retail-driven and fast money-driven. The structural buyers, central banks, are still there. And positioning in gold is still relatively subdued, which means what we're seeing right now is not the end of the gold trade. It's the reset before the next leg higher. Our base case, gold pushing towards 5,400 per ounce by the end of 2026. And the drivers are very clear. Central bank diversification, stabilizing real yields, and eventually about 50 basis points of Fed easing. Let's talk about something that most people are completely blind to. Flows. Because flows are not fundamentals. are going to drive the next 30 to 60 days. Over the past month, CTAs, these are systematic trend-following funds, have sold $85 billion in U.S. equities. They are now net short $37 billion. Let me repeat that. The same players that were mechanically buying the rally are now mechanically short. And what does that mean? It means if the market even stabilizes, not rallies, just stabilizes, they're forced to buy back like we're seeing right now at the same time. U.S. pension funds are expected to buy 28 billion equities into the month end. That's the 89th percentile historically. So you have a setup where systematic funds are short, long-only institutions are forced buyers. That creates a technical flaw in the short term. And this is critical. That does not mean the macro backdrop is bullish. It means any rally you get is a liquidity-driven bounce, not a fundamental recovery, even if tweets move it. And if you chase that rally, you're going to get trapped and cut up like sushi. You will not be Gucci. You will be cut up like sushi. Now let's step back and look at the regime we're in. Since 1973, when you look at periods of slowing growth and high inflation, equity returns are not just weak. They're negative on a forward basis. And the sector performance becomes extremely polarized. Winners, energy, utilities, stables, telecom, selective financials. Losers, consumer discretionary technology, industrials. Does that sound familiar? Because that's exactly what we're seeing right now. And that is not a coincidence. That is a regime alignment. Yet most portfolios are still positioned for deflationary growth environment. That's so huge. They're long high beta, ladies and gentlemen. They're long duration tech. Okay. Consumer cyclicals, that trade is over. Now let's talk strategy, because this is where the opportunity is. Right now, you need to think in terms of a barbell approach. Write that down. On one side, high-quality defensive, staples, telecom, select financials. On the other side, real assets, energy, infrastructure, inflation-linked securities. And in the middle, you minimize exposure, because the middle, the broad cyclical beta trend is where you get destroyed in stagflation. Now, on the asset allocation side, you should be not financial advice, just my opinion. Anyone retains any capacity. Overweight cash, underweight credit, neutral bearish on equities in the short term. I know people hate hearing cash, but right now, it's not dead cash. It's not dead capital. It's operational. Because when the momentum unwind fully plays out, you're going to get opportunities. But only if you have liquidity and you kept that powder dry and you kept that Gucci conviction clarity, not to get cut up like sushi. Let's talk Europe for a second, because they're actually an interesting divergence. European banks are starting to look attractive. Why? Because in a higher for longer rate environment, net interest margins wholly tech up. And unlike U.S. tech, they're not priced for perfection. So selectively, that's an area where you can add exposure. But again, selectively, this is not a beta environment. This is a precision environment. Now, let me bring this all back together again. What we're actually dealing with. Not financial advice, just my opinion, any retains any capacity. We're dealing with a market that is technically supported in the short term by flows, structurally pressured by inflation, and fundamentally challenged by slowing growth. That is the definition of stagflation. And in that environment, you don't chase, you don't overtrade, you don't assume the old playbook works. You rotate, you defend, you position ahead where the market's going, not where it's been. Because the biggest mistake investors make is fighting the regime. Right now, the regime is telling you very clearly, momentum is breaking, cyclicals are weakening, real assets are performing, and liquidity, not fundamentals, is driving short-term moves. So the question you have to ask yourself is, are you positioned for what's coming, or are you still positioned for what already happened? Because this next phase, ladies and gentlemen, is where portfolios either get protected or permanently impaired, unfortunately, and cut up like sushi. And the difference comes down to one thing, discipline and regime shift. Ladies and gentlemen, one good tip from the pits can easily pay for your entire year's subscription. If you want the deeper macro research and learn how to take advantage of all this, come join over 470 active traders invest in the Patreon, the Crypto Republic Desk Monthly. And welcome all the new members, because unfortunately the world's going to change, and it's whether or not you're going to take advantage of it. And I spend a lot of time going over what we do right now and why. And the people that retain us have come to rely on this. Being a financial mercenary allows you to do many things and take control of your own financial destiny, right? Because in a world where nothing makes sense anymore, what you know and what you do and your discipline begins to make sense. People are taking, at least family offices and large funds, what they're doing in more complex structures, they're taking advantage of the trading ranges, discipline, and acquiring as much at rock bottom discount prices of chosen cryptos. XRP, HBAR, ICP. I mean, these are just being gobbled up at rates that are unbelievable. And people are waiting for the change, the same way that you're seeing what's happening with the dollar system. The same way that if you're new here, I've been on and on and on about the unit, the BRICS. I've been harping on this for months. harping. That's why XRP is the answer. As far as we're concerned, what Ripple has built, XRP is the answer, the anointed one. ICP is the answer, the anointed one. H-bar is with them, the anointed one, they're the answer. The reasoning is unbelievable, ladies and gentlemen. But I want you to understand yesterday, there was a report that came out, okay, from Dune, a non-US dollar stablecoins reached a record high combined market cap of $1.26 billion. So in February, we went over reports for everyone that retains any capacity about the findings. They combined total supply of local currency stablecoins increased 70% from approximately 700 million in January 2023 to 1.2 billion by February 2026. That's so huge. So according to the joint report with local currency stablecoin supply, its increased ownership has become significantly more distributed. So from January 2023 to February, the number of addresses holding local currency stablecoins has expanded from 40,000 to 1.2 million. It's massive. The largest non-U.S. dollar stablecoin issuer is Circle's EURC. Its market cap has expanded from USD 153 million to USD 418 million over the past year. EURC proceeds USD 10 to 20 billion in monthly transfers, representing over 90% of volume among local currency stablecoins tracked in this report. The report also highlights BRLA, a Brazilian real token. Avina Pay, the core infrastructure behind BRLA, has seen rapid adoption, with monthly payment volume on Polygon increasing more than 6x, from roughly 64 million USD in January 2025 to roughly 404 million USD in January 2026. The report also highlights stablecoin stablecoin transactions, XSGD, and notes the pairs with the token consistency generates USD 20 to 40 million in monthly volume on decentralized trading venues. Massive. Ladies and gentlemen, crypto adoption is going global. Crypto adoption is going global. Let that sink in. Mind share in the crypto space has been dominated by U.S. embrace of digital assets. The Visa and Dune reports finding that local currency stablecoins have expanded by 70% over the past 3 years. However, underscores the crypto adoption is global. So, ladies and gentlemen, last week we were talking about Kazakhstan Central Bank revealing 350 million USD portfolio investing in cryptocurrency and companies and digital assets. That's so huge. Additional examples of the global nature of crypto adoption: Bhutan, Kazakhstan launching tokenized gold products last year. We went over that. Stablecoins carrying strategic significance. January, we remarked in 2025, stablecoins global strategic significance begin to crystallize for both the U.S. and international actors. Ladies and gentlemen, we've been talking about this over and over again. Even the ECB, they're explaining how stablecoins are reshaping global finance. Again, the U.S. dollar at the helm, and warned that without a strategic response, again, Europe could be left monetary sovereignty. Unfortunately, financial stability could erode. Unfortunately, again, that's what they're discussing. Not just, it's an opinion they're talking about, not financial advice. Global officials see the proliferation of U.S. dollar stablecoins into local economies as challenging sovereignty and national monetary policies. In response, support for local currency stablecoins aims to prevent dollar dominance tokens from displacing domestic currencies in emerging use cases such as peer-to-peer payments, such as agentic commerce and decentralized lending. So if you look at it like this, global lawmakers will be generally supportive of local currency stable adoption. Ladies and gentlemen, do you understand that when I would harp and rant and rave about the unit, the BRICS, Kazakhstan, Bhutan, where we are right now, if you've been taking notes of everything I said, and what I give away is for free, is unbelievable. If you just go off this, you're so far ahead of the game, because if you're listening right here, you know what's going to happen in the next 72 hours, where we're going and why. You're understanding the levels that we discuss. You're understanding how to take advantage of all this chaos. I drop these factoids into you, what I'm paying attention to, why people retain us any capacity to give them an edge. And again, ladies and gentlemen, if you want that edge, do come and join us in the Crypto Republic Desk monthly in the Patreon and take it to the next level, because the world's changing. So what people do right now, they take advantage of trading opportunities. They take a portion of the alpha that they make from those trading opportunities, and they accumulate for the long run, because the world's going to change. You're seeing it right now. You can't be a Luddite here. But I've gone over this. We went over this and why. With that being said, I love you all. If you made it this far, I salute you. This content is for informational and entertainment purposes only. It should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Remember, game is changing, and those who understand it first will benefit most. Make sure you're on the right side of it. You have two choices. Be like the crowd, reacting yet to the move, rationalizing why they missed it, telling themselves to never happen again. Or you can be the one who saw behind the curtain, the one who understood the infrastructure shift. The one in position early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise, while XRP continues to develop behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. Just open your eyes, smash that like button, ring that bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. I'll see you in the front lines. I love you all.